Hi everyone, my name's PK and here I have Shelly I'Anson with me. She's a mortgage broker in this episode. We're going through how to improve your borrowing capacity. You might be thinking, PK, you've already done like a couple of episodes on that already, and that's true, but we really did deep dive how to improve your borrowing capacity or preserve it through the trust structure, buying one or more properties in different trusts every time. For those of you for whom that's not right or you're not comfortable with it in terms of the risk appetite, today Shelley will be very generously sharing other tactics and strategies and approaches by which you can improve your borrowing capacity, hopefully get one more property or the next property, or even if you're buying to live, maybe these tactics will allow you to actually secure a deal. So what I did on my Facebook group, Australian Property Mastery with PK. There's more than 50,000 people there. I posted there who would like to come on and share their experience, their knowledge and tactics. And Shelley very gracefully or graciously, I should say, put her hand up. And so I thought, why not? Let's do this. And so that's why we're doing this session. And especially, she's quite a specialist in the non-conforming lender space. If you haven't heard about that, then this episode will be especially interesting and useful for you. I always say that, and this is not like a plea for your attention, but honestly, if you stay right till the end, there might be some gold nuggets here that may just get you that next property, four, five, $600,000. And who knows, in 10 years' time, if that thing doubles, then these next 30 minutes could have just made you hundreds of thousands of dollars. Anyway, that's the hook. But thank you so much, Shelley, for being with me and yeah, taking some time out of your day. You're based in Brisbane. It's a great day today here in Queensland. So I really appreciate you making time for this.
Yeah, thank you very much. What an introduction, PK. I hope I live up to that lofty intro. Thank you.
No, no problem. Well, look, the way I'm going to do this is I know that you have a bunch of notes to go through. I'll let you sort of drive the conversation and then I'll sort of just rudely butt in and intersect and interject, I should say, where I didn't understand something or I want to clarify it for the benefit of our listeners. Are you sort of okay with that approach?
Yeah, for sure. Let's dive in.
Awesome.
So I guess with a lot of major lenders, I guess my first point is something new that a lot of the non-conforming lenders have sort of brought into the market recently is lowering their assessment buffers. So classically, you put an application in with a lender, and your broker takes it to the servicing calculator to check out your serviceability. And the major lenders, or the bigger lenders, I suppose, tier ones, will look at your borrowing capacity with a assessment buffer of usually about 2.5%, sometimes higher, sometimes lower, but usually around there. Non-conforming lenders in certain instances and broadly can lower those assessment buffers to 2 or even 1% in some instances, which is obviously going to improve your serviceability significantly. Beyond that, we can look at, for self-employed individuals, we can look at low or alt doc applications. So, I mean, there's a lot of interesting, I guess, scenarios when you're self-employed where, business has improved recently, or the business is new, or you've changed your trading name, or, there's lots of variables when you're self-employed. And the major lenders can be, they can be harsh in how, or, particular on how they assess self-employed applicants. A lot of the non-conforming lenders can take more of a common sense approach. If you can show serviceability, they can use, your most recent two BAS statements or accountant finalized financials, or do you know what I mean? If potentially, your returns aren't up to date, or like I mentioned earlier, the 2 years differ. Last year was not as great, and this year business is picking up. It's hard sometimes to show or to prove serviceability in those circumstances.
Mhm.
I had a client not so long ago where their income was significantly higher than what their last two BAS could even show. So what we did was we went through line by line through their business banking statements and used those as evidence of serviceability.
Right.
There's a lot of different ways. If you've got a mortgage broker that's happy to do those yards and, you know, leave no stone unturned, I guess, to find where your income is, and then have the know-how to sort of present that to a lender in a way that makes sense to the lender. And we got those ones across the line as well. Like there's a lot of ways that self-employed income can be proven with non-conforming lenders, whereas the majors are like quite regimented in what they need to see, and it's usually the last 2 years tax returns, and they won't use, if this year's better than last year by more than a 20% margin, then they're going to,
Average it out.
yeah,
Yeah.
yeah, exactly. So they'll average over the 2 years, which, if borrowing capacity, if servicing is a little bit on the tighter side,
Mhm.
you really want this year to stand alone.
Right,
Um,
right. So, just a question on that. Like with, well, actually, let's just go back to the start in terms of non-conforming lenders. I mean, this is a bit of a technical term, and people may not know it. Obviously, you have the big four banks.
yep.
Everyone knows them, and then there are like tier two, tier three banks. Who are the non-conforming lenders? And I know this is a basic question, but I think it'll be helpful why they're called non-conforming, because it sounds like they're a bit, as on the face of it, sounds a bit dodgy, like they're not conforming to something, but there's obviously rationale behind it. Who are they, and why do they act differently?
Yeah, sure. So there's a number of non-conforming or tier two or three lenders, I guess, that are in the market at the moment. So the predominant ones, or the big guys in that space, are your Resimac, your Pepper Money, Bluestone, Latrobe. Like these guys work in this space, and basically the way that they get their, or they package their money, is different. Like they warehouse things differently, and that's all quite technical. But they've got I guess, more margin for grace than what the bigger lenders do, for those reasons.
Right. And like these, I mean, it's great. We get the additional borrowing capacity through these non-conforming lenders, and they don't simply, let's say you're a business owner, they don't just take your last two tax returns and average them out. Like you were saying, Shelley, if you have a good mortgage broker, then you can go, at a more granular level and be like, all right, there was a bit of cyclical nature in my revenues or my costs or my earnings in general. Let's see how we can eke out the best serviceability outcome, is instead of just like two tax returns, take the average.
Mm,
But there is a higher interest rate, right? Like you, correct me if I'm wrong, there's a high interest rate you have to pay as a lender, sorry, as a borrower, from these lenders. Is there like a rule of thumb, like over CBA, are we talking 2% premium in the interest rate? Are we talking 3%? Or is there much variation between the different non-bank
yeah,
lenders?
sure. Look, there can be a little bit of a higher premium to pay. Absolutely. So when you start getting right down into a particular niche and needing a really specific product, then you're sort of at the mercy of the lender that can offer you that product. That being said, they're not always, 3 or 4% higher than the going rates. Um, and if it's going to get you into that property now versus waiting for your next year's tax returns to come in and you can show serviceability across 2 years. And by that stage, potentially the market's moved on or up. Certainly, locally here in Brisbane, I know that the market trend over the last 3 or 4 years has increased dramatically. So if you're waiting for your income, or to be able to prove your self-employed income versus just paying, a small premium now to get into the property, it's completely up to you. But, sometimes it's definitely worth it. So yes, in short, I guess they can be slightly more expensive, but in the long run, getting into your property and paying that premium and potentially refinancing in a year or two time when you can show serviceability to a major lender, then I guess you've won in that instance.
Yeah, probably not. I mean, not in all locations around Australia, but certainly not Brisbane as well as, probably Perth, regional Queensland, parts of Victoria, definitely most parts of South Australia. Probably, I would almost say the majority of Australia, not everywhere, but the majority of locations are rising so fast that, of course, notwithstanding your own household income and cash flows. You need to make sure you can actually pay, the interest and everything. If you can, then waiting, another year before you can get that same property, you're going to probably pay, I don't know, 50,000, 100,000 plus more
Yeah.
extra for that property. So if you can work with a mortgage broker and get it done, then it's probably a good idea to do that. This is one more question. I know I'm sort of taking up your time, but what's like the minimum? Like, let's say someone's recently started a business, I don't know, like a year ago or 6 months ago, 18 months ago. They don't have like 2 years of financial statements or tax returns. What's the absolute minimum tenure in business that one needs to be able to get a loan?
Yeah, so there's a couple of parts to that. So most of the lenders, non-conforming or otherwise, want to see the ABN registered for a certain amount of time. I think 1 year, 18 months might be the minimum there. But as far as showing profitability and serviceability, then 6 months is what they like to see. So I've put in applications before with non-conforming lenders using the last 2 months BAS statements or the 6 months of banking transactions. So and gotten them across the line using those alone. 1 year's financials, obviously fantastic. And a lot of the non-conformings will actually assess those like a full 1 year's financials as a prime deal as well, rather than, moving into the higher interest rate, more specialist sort of products.
Got it. Got it. Well, yeah, let's talk about actually one sorry, one more question that's just come to mind. Let's talk about low doc loans in a second. But
Mm-hmm.
often on the Facebook group and other places, Shelly, I get asked the question that is it safe for me as a investor or a home buyer to go with a second tier or third tier lender? Because just the name second tier, third tier, or non-bank or non-conforming lender, it connotates some sort of risk. So apart from the interest rate premium that there might be, is there any other risk to me as a borrower from going to one of these lesser known lenders?
No, as a consumer, I think the risk is quite minimal in that respect. A lot of the non-conforming lenders do have their own money, if that they're lending, and then I guess they package those and sell in warehouse to investors. So it's a tricky one. I'm a little bit nervous about that response, PK. Um, so I guess the long and the short of it is no. I think that the risk is minimal
Yeah, and
to
also
the
I mean, it's not
consumer.
like we're putting a deposit with them, right? I mean, and then that bank goes bust. It is like all our money is gone. In fact, it's the other way around. If something happens to them, they're the ones who've lent us money. So it's like it's
Yeah,
not our money. So I mean, I
yeah,
don't know. That might be, I'm a bit nervous about that response myself, but it's like a kind of a naive kind of comment, but that's
yeah,
also the long and short of it. It's not like if that bank goes bust, then you've lost your money. In fact, this is probably not right, but you don't have to pay them back. No, that's probably definitely not right. But yeah, it's definitely not a deposit that you've lost. So,
no.
but let's talk about low doc loans. I mean, there are so many people that don't know about them and are sort of not able to buy property because of a lack of understanding. Like, what are they, and or alternative doc loans, and how can we use them?
Sure. So I guess to break it down is we probably start at what a full doc application looks like. So a full doc application for a self-employed customer is the last 2 years full financials, tax returns, notice of assessment for the business and the individuals applying for the application. So anything outside of that or less information than that the lender will accept is technically low doc or alternative documentation. So alt docs tend to look like the last 2 months to BAS, so 6 months worth of BAS, or 1 year's financials or business banking statements to prove serviceability. So if there is income there, and mortgage brokers have responsible lending to keep in mind when putting any application in. So, I would, my goal is to get my clients into their property by proving serviceability by how they are showing their income, right? So I have extensive notes on all of my clients because I don't, at the end of the day, this is my livelihood as well. I don't want to get in trouble.
Mm-hmm.
So showing where the income is in an alternative documentation standpoint, or using the BAS or using the business banking statements is probably as much detail as anything else. It's not accountant, I guess, supplied or drafted when you're going through the bank statements, but you're actually going through line by line, like, this is a business expense, this is income. Do you know what I mean? And separating what they're doing and being able to show that and prove to the lender, who ultimately makes the decision at the end of the day whether they pass assessment or not. So
right. I guess that's a lot of work as well for a mortgage broker if they are going through that line item by line item. And I mean, I'm just making this up here, but I don't think most brokers or many brokers, maybe some brokers, they probably don't want to do that. And so it's a case of finding the right broker. If you're going to a big chain, like finance company, then they're probably not going to do that. But like a niche operator, like I'm always a bit impartial. Sorry, I'm a little bit partial or biased towards sort of small mortgage broker outfits, like where they're a small company because there's like one or two people that are the main face of the company or the business, and they really know all of their clients pretty well, and they've got the time to get into the weeds. And I think personally, I mean, there might be other great brokers too, but personally, I find that those brokers get the best outcomes for their clients. And Shelly, you're obviously like in that boat, like a hardworking sort of small business type operator. Just take me through. This is a bit of a subjective question. I don't know if you can answer it or not. Some brokers tend to be a little bit, let's just say, more lenient and stretch the truth a little bit more. Others are a little bit more, compliant and more risk averse. What are
Mhm.
the consequences in the brokerage industry of someone who's been far too lenient and stretched the truth of their clients too much? Like if, I don't know, the client stops making their repayments to the bank, do the banks come to you and be like, hey, Shelly, tell us how you got those numbers to work, or how does it come back on you?
Yeah, absolutely. So I guess the first person that the client is going to blame in that instance is the broker that wrote the loan. So I feel like the lender goes back to the consumer and says, "Hey, why aren't you paying your mortgage anymore?" And they say, "Well, I can't afford it, but this guy, wrote my loan for me. I don't know what they do. Them. And then all of a
Mhm.
sudden, this guy happens to be in the limelight, under the microscope and needing to prove exactly what they've done and how they you know, got to where they got the loan approved." So,
Right, right. So I think the summary maybe is that some investors were right at the edge of their borrowing capacity. They love a broker who can stretch the truth, but just be a little bit ethical at the same time, because if in fact you can't afford it, then it's the poor old broker that gets the short end of the straw. And I think that's not discussed enough in the industry, at
Yeah.
least not amongst the members of our Facebook group. Everyone high fives the next loan, but you need to make sure you have the ability to actually pay it off. And can we talk about bonuses? Like how do bonuses impact your borrowing capacity? Maybe a lot of people are commission based. Like how does that all work?
Yeah, so a lot of the major lenders, especially PK, will have um, a, a shading of bonus and commissions, and that's usually shaded at to about 80%. So you lose 20% of your bonus and commission income. The same is true for like non-essential overtime, especially for non-essential workers. Like when you start moving into essential workers, I think they'll take your full income, but non-essential workers overtime absolutely get shaded as well. A lot of the non-conforming lenders will use 100% of your bonuses and commissions, which really helps. It really does help.
And I remember when I used to have a PAYG job, I think if I remember correctly, you needed to have a bonus 2 years in a row for it to count. Am I remembering that correctly, or is there ways to just have the most recent years also be counted?
Yeah, so a lot of them like to see 2 years. If you can show on um, especially at this time of the year or potentially next month on your next payslip, if you get a commission early on in the season, and you can show this year. Do you know what I mean? Like you need to show a couple. Um, in that instance, if you PAYG, last year's income summary will be particularly helpful to you as well. If you're new to the role and you can show, I guess, what your commission structure looks like or your bonus structure looks like, then you can potentially use your employment letter to help that along. But yeah, oftentimes that's right. They want to see at least a couple of bonuses or commissions in there to just show that it's going to be ongoing.
Right, right. All right. Well, before we wrap it up, I might ask you as well. Like we've talked about non-conforming lenders, we've especially for business owners. Perhaps for those who aren't business owners that are your clients, I don't know, what are perhaps like the top three, one, two, or three other ways by which people can do something to get a higher borrowing capacity? Maybe their borrowing capacity is only 200,000 and then they really need 300,000 to be able to get into a quality asset. Is there any other things that come to your mind where you can be like, all right, maybe consider these three, four, five, whatever things that might just get you over the edge?
Yeah, absolutely. So I guess the biggest thing is that you have all of the lenders will look at how much you can borrow in total. And if you've got things like car leases, if you've got things like credit cards, store cards, they're looking at not just, they don't actually care whether you pay your credit card off month to month. They do care what the limit is. So if you've got a $10,000 credit card, but you only use $1,000 a month and then pay it off, they still look at that $10,000 limit as part of your serviceability. So that's $10,000 less plus the buffer that you can't borrow on your mortgage. So steering away from those sorts of things, minimizing obviously any other borrowing that you've got or have or interested in. Car leases are probably the biggest one that slow down servicing in my experience. Um, but other than that, it's you just need to show what you can earn and keep your lending minimized. Your other lending minimized
Awesome.
is the best advice that I've got.
And what about Hex? Does Hex work in the same way as a credit card where it doesn't matter how much loan you have, the fact that you have it is what you're penalized on? Or is really the quantum of Hex debt outstanding directly proportional to how much borrowing capacity you've lost?
Yeah, HEX sits a little bit separately in my experience with writing loans. Most of the lenders usually look at what your HEX repayments are per year, and just work off that, plus whatever buffer they pop in the background. HEX doesn't usually slow down serviceability too much, in my
Okay.
experience.
Okay. And one last question, because I know that I always get asked this. Maternity leave or even paternity leave, but let's just go with maternity leave. Um, let's say, someone's off work for a year.
Mm-hmm.
In that time, is it like necessarily the case that the borrowing capacity has dropped, or that, the husband's still working, they still have good cash flows, they want to buy a property even though one of them's off work for a year? Is there still a way through like letters or some other way where they can still show that, oh, I still got my full-time job, still give me a loan based on that income as well?
Yeah, absolutely. So a lot of the lenders, some lenders are better in this space than others, but a lot of the lenders will allow a borrower to use a return to work letter, for example, or um, if you are um, being paid from the employer throughout your maternity leave, then you can use that income as well. You just need to basically outline line by line what it all looks like. So a return to work letter showing when you're going to come back to work, what your rate's going to be, these are your hours. Obviously, after a year off maternity leave, a lot of people go back, trickle back into the workforce rather than come back full force, or full time even. So just proving what that's going to be, absolutely is acceptable.
Awesome, awesome. That's I think, yeah, hopefully these tips and tricks and understandings can kind of jostle people into the right mindset and sort of thinking process where they can be like, okay, let me talk to my broker, because there's so many other ways you can, eke out another 100,000, maybe even 200,000 to get to your next property purchase. So thank you so much, Shelley, for your time. Could you just share how people can get in touch with you if they want to?
Yeah, absolutely. So my business is Compass Lending Group. You just pop that into your Google search and you should come up. Or you can find me on Facebook as well.
Awesome. Thank you so much, Shelley. And guys, thank you for watching or listening. I really trying really hard to get just grassroots operators, just sort of humble professionals in the industry onto my platform so that you can hear directly from them. I think we all know of the people who are always on social media and things, but I think there's something to be learnt from the smaller operators as well. And they're really very, very valuable. So Shelley's been very gracious to share that with us. There's so many incredible mortgage brokers, whether it's Shelley or someone else. Make sure you use one. Of course, you don't have to use a mortgage broker, but my strong recommendation is, unless you have like 15 plus properties, it's probably a good idea to see one. Hopefully that brought you value. If you want more and more videos on how to get additional borrowing capacity, because I know it's always the topic of the day, then leave a yes in the comments below. And if I get enough yeses, I'll just get more and more mortgage brokers and different specialities to come onto the channel. Shelley is really deep in terms of the non-conforming lender space. Like I said at the top, we've had previous episodes on how to buy in trust structures, thereby expanding your borrowing capacity by a long way. There's other ways to do it as well. Let me know if you want those sessions. But thank you for watching. Thank you for listening. Hit the subscribe button, give it a thumbs up, and thank you once again, Shelley.
Thanks, PK.